Yo, what is going on, everyone? I hope everyone is amazing. It's your boy, Kieran Davis, aka the Master of Client, and today we've got another trading video. And guys, I'm really excited to share this video with you because today we're going to be speaking about structure. Now, when it comes to structure, I believe this is one of the most underrated yet most powerful tools in the whole industry of Forex, or whether you're trading stocks or crypto, right? Any sort of charting analysis structure, guys, is so important. Now, there's a few misconceptions about structure, and there's a few things that I really want you guys to understand. And I know if you apply what I'm going to teach you and you back test it and train your eye, then your trading is really going to be taken up to a next level. So let's just start with super basic structure, right? So we've got three different types of markets, right? So we've got we've got an uptrending market. We can call it an uptrend / we can call it a bullish market / a mark up phase, right? Now, whether you hear mark up, bullish movement, impulse, like guys, there's so many different words. Like there's so many different words. I'll be real with you. It doesn't really matter what you use, but all it matters is you have the definition correctly. And see, this is defined by a series of highs and higher lows. Well, higher highs rather, a series of higher highs and higher lows. So when you're seeing this print, this would look something like this, right? You get a low, price rallies, you get a high, you then come in and create a higher low because obviously this low point is now higher than that point. But this is still not going to validate our structure. You see, for structure to be valid, you need at least 4 points. You need 4 points of structure. Now, this guys is the most important thing because this is where a lot of traders go wrong when they don't see these 4 points of structure. Now, you might be thinking, well, Kieran, where are the 4 points of structure? Well, look, let me show you. Let me actually put these little clipses on there so it'll make it a lot easier for you guys to see. So we've got our 1 point. All right, let me make this blue as well because we're looking at an uptrending market, right? So we've got a low, we've got a high, we've got a higher low, and now we've got a higher high. So you've got 4 points of structure here. 1, 2, 3, 4. And when you see a scenario like this, when you get these 4 points, typically what we can expect is some sort of retracement back down. Now, whereabouts will this retrace to? Well, this is where we apply our other concepts and really start to refine our entry. But, that's for a whole nother video. So if we now come in to create a retracement, we can expect this to come and pull back to a certain point before coming up and creating a new higher high because we are in this trend. And this is the type of trade we're trying to catch. We're trying to enter somewhere here and obviously take this trade higher. Now, let's say if we're looking at a downtrend. You see, when it comes to a downtrend, now downtrends, again, there's another 101 different labels and words. Everyone, guys, pretty much all the Forex strategies, I'll be real, are the same thing. It's just different perspectives of the same car crash. It's like, for example, break and retest and institutional candles. It's pretty much the same thing. But as long as you understand the theory and the market behavior behind it, the labeling doesn't really matter. So this is classed as a bearish trend / markdown / impulse. And this is defined by a series of lower lows and lower highs, right? Or, again, the labeling doesn't really matter what order you want to put it. But as long as you understand the general picture that you're getting a high point, a low point, a lower high, and a lower low. And now we've got our 4 points. We've got our 4 points of structure that have now validated this. So we can now look for entries. Now, I'll show you guys examples of incomplete structure and where you need to be patient. But again, we've got our 4 points of structure. 1, I'll make them red. So 1, you've got your high, you've got your low, number 2, number 3, and number 4. And as long as price keeps printing these points, then you're good to stay in harmony with the trend. We always want to be staying in harmony with the trend, because it makes more sense capitalizing from a position from here to here compared to from here to here. There's just more on the table, trading with the trend. And I know for some people who are advanced, that sounds so basic, it sounds so simple, but guys, you'd be surprised how many people, when they're applying it, when the emotions of the market, when the market's actually moving, fail to apply it correctly. So again, if in this downtrend now, we're essentially looking for this pullback and anticipation for price to enter us if it gives us our entry requirements, and then to continue down. Guys, that is simply it. Now, there is another type of market which is called a, we can call it a consolidation, but more so, instead of a consolidation, this is where you just get your your accumulations, your distributions, your accumulations of price, these different phases that the market goes through. Because the market does move in waves, and the reason, guys, it moves in waves is essentially because of the supply and demand. What's happening, in an area like this, right? Let me get the different pen. What's happening here? We're going to get a demand zone, right? And we're going to see the only reason price to go from here to here, the only reason that price is going to rally is because of demand, right? Demand has outweighed supply, and that's why price has rallied. And then what happens during this pullback is you're seeing some profit taken. So anyone who purchased the market down here at these cheap prices, they've started to take some of their profits potentially, or they're starting to hedge back in. When it comes to institutions and the larger players in the market and the way they actually operate price, you see, they're trading with so much capital, they can't just, enter a position. They have to hedge themselves in. But that's something for a whole nother day. I think I even do have a video about that on my YouTube channel. But again, what they're doing here, they may be entering more positions, right? Adding to their positions, taking some profits, shaking some people out, all the latecomers, right? All the noobs who were chasing price, chasing price, chasing price, chasing price, chasing price, chasing price. This comes to now shake them out. Oh, no, it's dead. It's a scam. It's a scam. Oh, they get out of the market, wash them out before rallying price up. And it's just these cycles of emotions that keep playing. Guys, the market is designed for as many people as possible to lose. Now, when it comes to these 4 points of structures, guys, let me show you what you wouldn't short. So if you're looking in a bearish market, right, you wouldn't sell something like this. If you see something like this, this could be what we call a complex pullback, because here, right, we've only got 3 points of structure. We said we need 4. So where are the 3 points? So you've got 1, 2, 3, and this has not created a 4th point of structure because it has failed to break this low yet. So in situations like this is where we need extra patience, and we need to wait for the market to print that new lower low so that we can obviously wait for the retracement to short it lower. Now, sometimes price can actually fake some people out, and it can give us what we call a complex pullback. Now, a complex pullback is where maybe you short up here, you short in this area up here, and then price pulls back even higher, and now you're seeing a potential bullish trend, right? Now you're seeing a bullish trend, because now on the lower time frames, you're going to get sucked in because you've got your 1, 2, 3, 4 points of structure, right? Yes, that is potentially valid, but you got to understand the bigger picture, and you need to understand what's happening with the higher time frames and the momentum, because we're still trapped within that higher time frame swing. Look, we're still trapped in that high point and that low point. So price can ping pong all day long within these two red zones, from here to here. Price can ping pong in between these zones all day long. This is why we wait for lower time frame entry confirmations. So let me just clear this and break something else down. So the next thing I want you to understand is that each time frame has its own unique structure. Each time frame has its own unique structure. And this is the fractal nature of the market. So for example, let's say, for example, we've got a bullish market, right? So we've got a high, higher low, higher high, higher low, and we're getting a higher high. Now, this could always be, on a daily time frame or a weekly. Now, typically, guys, your weekly and your daily time frames, these are going to give you a directional bias. These are going to tell you where the dominant energy in the market is, where the bigger agenda is, right? Is there more sellers overall in the market? Is there a background strength? Is there a background weakness? And when you have that background strength or background weakness, this allows you to get those monster risk reward trades, because it's all about positioning, understanding. Am I trading a retracement or a continuation, right? Sorry, the reason I had to say it like that was because I'm not the best speller. So we've got a retracement and a continuation. We need to understand what we're actually trading. So when we're trading retracements, don't get me wrong, like they are valid. You can trade these retracements, right? You can capture these shorts from here, but this is where your lower time frame comes in. But understand the higher probabilities And the monster trades you'll be getting are these continuation trades, entering the market here. And obviously you can hold it up to here. But let me break down one thing I mentioned earlier. So I mentioned earlier that each time frame has its own structure. So this could be the daily time frame, right? Now, let me just change the color. And let's say we're now looking at a 4-hour time frame, right? I'll make the 4-hour time frame blue. So if we're looking at a 4-hour time frame now, what we're going to see is we're going to see the same fractal nature, but what's going to happen is it's just going to be creating its own independent structure on the lower time frame, right? So there's trends within trends. There's trends within trends. So this blue time frame now is the 4-hour time frame. So within this one impulse, right, from, let me get the black pen so you can see, from here to here on the daily time frame, that is just one move. But on the lower time frames now, we can see that there is much more trends in on the lower time frame, so that we can now get higher probability to take these trades. So if we were buying this market, right, we'd want to be buying somewhere here. Why? Because we want to wait for those 4 points, right? So we get our 1, 2, 3, 4. Now, guys, let's say we have a point of interest here for whatever reason, right? Let's say these two, no, this is a demand zone, and for whatever reason, we're looking to buy in there. Now, when price approaches here, when the momentum is coming from here to here, what I want you to understand is that price is actually in a downtrend. Because look, we're getting a series of low, lower high, lower low, lower high, lower low, lower high. So we're in a downtrend. So we just can't. So this is gambling. If you're buying here like this and potentially, trying to take price higher, that's gambling. Because don't get me wrong, of course, the higher time frame, there is strength, but we don't know that price is going to actually going to reverse that, right? I don't want to be trading, I don't want to be guessing. You need to understand that every movement in the market is very intentional, right? These bigger players, guys, it costs a lot of money to move the market by 1 pip, right? They're not here just to gun for retail traders. That's what one thing you need to understand. And they're very intentional. So they leave footprints with what they do. And that's all we're doing. We're waiting for the evidence. And once the evidence has been presented, we can now act accordingly. So let's say, for example, right, we didn't even see, this side of the chart. Let's say price is approaching our point of interest. We can't wait now. We have to wait. We can't just buy this area. Because again, we don't know if price wants to, come down here to some other points of interest, right? We don't know that. So that's why we wait and let the market show us and tell us what it's going to do before we actually execute our trades. So what we're going to look for is these lower time frame breaks of structures, because what's going to happen now when it comes to these trends, one thing you need to understand, right, is when there's a reversal, right, we keep trading with the dominant energy until the last low that led to a new high is broken. So this remains bullish until the last low that led to a new high is broken. So if we saw something like this now, right? If we saw something like this now, let's say something like that, again, we could be getting that complex pullback. This, we wouldn't be buying here because this is the low that has not led to the new high. However, this low here led to a new high above this high. So again, that's where traders can get faked out. So what we need to do is we need to pay attention to that last low that led to the new high. That is the most important part here, right? The last low that led to a new high. Now, until this point is broken by a candlestick body, not wicks, candlestick bodies, you want to see a candlestick close below this level for that to give you a break of structure. Now, when that gives you a break of structure, what is that showing? That's showing you that there was so much demand here, right? There was so much demand here that price come up and created a new higher high. But when price come and broke through now, that's showing you there's no demand left in that area. There's only supply. There are only sellers available. So we can now look for price to, pull back to any of these areas at a valid point of interest before shorting it to the downside now. Now that's a little bit more advanced, but if you want to take it super, super slow and super patient, you wait for your 4 points like this, 2, 3, 4, and now you can go ahead, get that pullback and, take price much lower. So when it comes to, these downtrends, it's the same thing in the downtrend as well, right? So the last low the last high that led to a new low in the downtrend. So this is the last high that led to a new low down here. So price can do what it wants in between these 2 points. It can do this, it can do this, it can do backflips. Like, it can do what it wants, right? As long as we don't see price close above this area, we're still good to keep shorting. So price comes up, breaks below that point. Well, we're now in a bullish environment. We can now look for that pullback to take price higher. So that is that evidence for that break of structure. That's what we want to see. We want to see that evidence. So for example, here, we now know that we have the higher time frame, the daily time frame here, but the 4-hour momentum is to the downside, right? So the 4-hour looks like a retracement, like a downtrend, but that's just a daily retracement. So now when it comes into this area, what do, right? We wait for higher confirmations. We want to wait for the market to show us what it wants to do rather than us impose our will on the market. Guys, the market is literally a language. Think of it like that. And it's always communicating to you what it's going to do next. It's just, can you interpret it? So we can see here now that we've got our, if we're looking at the structure points, right? Let me put the little circles on to make it really clear. We've got a lower low, a lower high, a lower low, a lower high, and a lower low. So that's a valid downtrend until what happens? Price now comes up and breaks structure. It gives us a break of structure. Remember, the last low, in the downtrend, it's the last high that leads to a new low. And in the uptrend, it's the last low that leads to a new high. So this now gets broken above. And because price is now broken above here, because again, in order for price to go from here down here, there had to be more supply. There had to be more sellers in the market than buyers. That's the only reason price went from up here to down there. So in order for price to come back now and break through that level, that's showing you the demand is more prominent. There's stronger, there's more demand in the market, which has just shown us. So now what can we do? Well, we've now got more confluence because now, for example, your daily time frame is, bullish. And now your 4-hour time frame is now bullish compared to, because where would you look? Where am I referring to the buy? If you're buying here now, right? Because now the 4-hour time frame is now bullish. And this is how you can now minimize your risk, because now your stop loss can go just below there compared to if you were, buying on a daily time frame here, realistically, your stop loss would have to kind of go below this whole low. So this is now giving you higher confirmation, because if we were just, buying the market as it approached to that point of interest, well, yes, the daily time frame is in an uptrend, but the 4-hour time frame, which is in blue, is now in a downtrend. So we have to wait for those time frames to flip. And again, you can now take this down to a lower time frame, such as the hourly time frame, 15-minute time frame, 5-minute time frame, 1-minute time frame, 1-second time frame. It's fractal. It's the same thing on each time frame. So now this is how you can get those monster risk reward trades. Because now check this. As price comes down, let me change the color again. Let's make it green for money. So now let's say this is the hourly time frame, right? As price is rallying, it's doing its thing, comes down, lower high, lower low, lower high, lower low, comes up, breaks structure. That can be your entry now, and price can continue. Now I know this is looking a little bit chaotic, but let's just follow the general points of structure, right? Because that's what's important, guys. When you're looking at a live market, the drawings are not going to be perfect. As long as you can make out, the structure points, that's the most important thing, right? We've got those lower highs, lower lows, right? Lower high, lower low. And then what happens? We get the break of the structure. So now we're waiting for even more confluence, because now when you enter somewhere like here, you're now in alignment, because look, the daily time frame is bullish, which is the red one. The 4-hour is now bullish, which is the blue one. And now the 1-hour, the green one, is now bullish as well. And now this is where you can get an even smaller stop loss, because now your stop loss can go here. And you can now, because you're in alignment with the higher time frame, you can now hold this trade for much longer and get those massive risk to rewards compared to, entering here. Your risk to reward would be, obviously still good, but again, this is just a pure hypothetical example, 1 to 5. And then if you went on the daily time frame, your stop loss would have to be all the way down there. And your risk to reward maybe is like a 1 to 1, 1 to 2, But if we now refine it, we can see entering on the 4-hour gives us a 1 to 5, but entering on the hour gives us what example is that? is a 1 to 20. So that's just the theory, guys, of structure and the fractalness. Now, of course, guys, I'm going to show you a few examples. So when it comes to these examples, honestly, guys, at first, it's going to be very hard for you to find this because it requires a lot of back testing. It requires a lot of back testing to train your eye. But look, let's just hop right into the examples. So let's look on Euro USD. So you'll be able to find this anywhere on each time frame. So let's look on the daily time frame, for example. So let's remove all the drawings and let's look at the structure. One tip for structure, I sometimes use the line chart to get rid of all the noise. So if we're looking at the structure now, right, we've got one higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low, higher high. What happened? Price came down and it broke structure. So we're now in a bearish market. So now we'd be wanting to look for shorts in the market. But what's going to happen, guys? Remember, on the lower time frames, it's going to always turn on these lower time frames. So if we now look on a 4-hour time frame, within that 1 point of structure, there's now going to be multiple trends within the trend. So if we change this now to let's say we change this to a red color, right? There's now, look at this. There's structure within the structure, right? On the daily time frame, that's just one impulse, right? On the daily time frame, if I remove all my drawings, then this is just like one impulse, guys. 1, 2, 3, 4, right? You got from here to here, but within that, there's more and more different structure points. And let's try and make it clear with the circles. I think that'll be easier. So look, we got low, higher high, higher low, higher high. On the daily, it's just a couple swings. But on the 4-hour now, within those swings, we're gonna have the swings within the swings, right? The fractalness of the market is gonna start to play out. So let's say, for example, we was looking, for a reversal, right? Or just to trade or continue, or even a continuation, right? Now we've got this little institutional candle here, which price came and reacted from. So if we was going to buy, the market down here on remember on the hourly time frame, that's a downtrend. So if we look on the hourly time frame now, look, we're looking at the structure. We've got a higher low, higher high, higher low, higher high, boom, 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 boom. Broke structure, downtrend. So how are we going to know if we're going to buy it down there? And if we keep breaking it, well, that's why you keep looking at the structure and let the structure tell you. Because if we keep zooming in, let me just replay this back here. If we keep scaling in, if we look for example, on a 5 minute, or even on a 1 minute, or even a 5 minutes, perfect. We didn't need to go on a 5 minute. We can see on the way down, cool, price in a downtrend, right? Boom, 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 lower low, lower high, lower low, until we get that breaker structure. We get that breaker structure, and we get an accumulation at the point of interest. So now we can go ahead and that for a long. Again, this is just a hypothetical example, but look how much your stop loss is going to be reduced now. Your stop loss can be drastically reduced. And if we look left to find our targets, well, we've got all this imbalance up here that needs to be filled, right? Imbalance. We've got liquidity above here, equal highs that need to be filled. More liquidity above here, more liquidity above here. So your risk to reward, guys, your risk to rewards now are naturally going to be heightened. This is now, look at that. That's a quick 1 to 30 example. So what I'm saying, guys, is this is the power of looking for those structure breaks on each time frame. Because on each time frame, guys, they have their own structure, but it always builds out from the 1 minute time frame. It's like the ocean, right? Think of like the 1 minute is like your small ripples. Think of like your 15 minute as your waves. And think of your hourly, your 4-hour as your much larger waves now. And obviously your daily and weekly time frames are your tides. Guys, the market really, really reminds me of water. Think about it. Currencies, right? We're trading the current, we're trading the flow of money. A bank, think about it, a central bank, they're the top participants in the market, and banks control the flow of water. So a bank also controls the flow of money. So what you got to understand, guys, that these markets are not random at all. They're systematically delivered on every single time frame. So it's understand it. And when you're in tune with structure, you can start to anticipate, next potential moves. And again, this trade here now, you could probably even held that much longer for higher targets, because again, the daily time frame the daily structure, right, is you're in alignment with the daily structure. Because you're in alignment with the higher time frames now. Look, price even went much higher after that, right? And obviously, it done its thing. But this is what I'm saying, guys. This just shows the importance of making sure you're in alignment with these different structures on each time frame. Now, again, this is a very, very quick and brief video. If you guys do want more information on structure, definitely send me a message on my social media on Instagram. If you guys want any mentorship, access to more resources, and we can take it from there. But guys, thank you so much for plugging in. If you guys want to see some more examples, you guys want more videos from this, definitely give me some feedback in the comments down below. Any questions, I'm more than happy to ask. But with that being said, family, thank you so much and have a great week.